My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people make friends. I'm just trying to make you a little money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. Yesterday, everyone was tearing their hair out, screaming about an inevitable recession. Today, we realized we aren't getting much evidence of recession, at least from the corporate world. So the Dow gained 294 points, S&P climbed 1.04%, and the Nasdaq jumped 1.03%, respectable. I think we're in a recessionless recession because I follow the actual micro data from individual companies that report. The people who only follow the Federal Reserve never want to get their hands dirty and do their homework. They just spend all their time trying to second-guess Jay Powell. They remind me of disgruntled Eagles fans who think they know more than the coach or the general manager. Let me show you what I mean. When you run down the companies that reported in the last 24 hours, it's very hard to make the case that we're headed for a serious recession from here. I want to go right through. All right, let's start with Palantir. Last night, CEO Alex Karp told a story of huge contracts won, massive $10 billion contracts that produced 27% revenue growth when Wall Street was only looking for 22%. He's doing it with a tremendous breadth of AI and says there's unprecedented demand for these solutions. Even though Karp can be a little too colorful, it was a solid boost to those of us who believe in AI. Next, did you see Lumen today? Most people I know had written off this debt-laden telco company. Last night, though, Lumen announced that they're secured $5 billion in AI business with the possibility of another $7 billion in AI-related work with its fiber network. That is extraordinary, people. Stock rallied like it's getting multiple takeover bids. After the close tonight, the company delivered its full second quarter report, and despite a mixed result and a full-year guidance cut, the stock's climbing higher still. It went from a little over $3 to $8.80 in a single session. Don't you wish you had that one? I always like the rails as barometers of economic activity, which is why I like that CSX quarter so much this morning. This company, they reported last night, but this stuff just took off. This company has a vast panoply of cargoes, and they were almost all ahead of plan. Plus, CSX has this unique chemical franchise owing to its proximity to all the plants that make plastics from our country's incredibly abundant natural gas. CSX saw real volume gains and price increases, not just questions about how it's operating its trains. If you didn't know any better, you might think that there's a boom in the Southeast, not a recession. Two different cyclicals reported today, Caterpillar and Builders First Source, and both were sharply better than feared. Builders First Source, a housing supplier, bucked the weakness in remodeling and renovation, putting up robust numbers that should only improve as interest rates come down. All right, the company didn't blow away the numbers, but it had remarkable gross margins, suggesting the business is holding up much better than we thought. Plus, they're giving you $1 billion buyback. Buy! When the whole company's only worth $18.1 billion. Maybe you should join them. As for Caterpillar, I was stunned by how well they did in this environment after all these rate hikes. Record earnings per share up almost 8% year over year. Strong margins, expanding backlog. This is extraordinary at this point in the cycle. Remember, the economy is supposed to be in terrible shape at this point. But Caterpillar, it is doing great. So Builders First Source triumphs over a very hard environment in the repair and remodel business. We've covered this company, while Caterpillar is delivering record numbers in the economy that's supposed to be teetering. That's not what happens in a recession, people. But do you think any of those wolf criers have even heard of Builders First Source? Do they know the cat gave you a record quarter? Of course not. That's not what they do. Last night we had Stephen Yalof, the CEO of Tanger, on the show, and he told a very good story about the strength of factory outlet business. Sure. All right, factory outlets. So they work great in recession, so maybe that's a sign that there's a recession. Wait a second. How about Simon Property Group today? The largest owner of enclosed malls in America. They have to be cratering here, right? Wrong. Simon Property reported a true blowout. Much better than expected. They have almost no vacancies, having signed 1,400 leases with 30% new customers. They had a 5% increase in traffic in the malls. They gave you a 2.5% dividend boost. While CEO David Simon acknowledged the lower end of the consumer is strapped, he exuded confidence in the call. I know this man. That confidence is real. The stock finished up 5%. What else? Now, okay, let's puzzle over this. If there's a recession looming, Uber's customers don't seem to show it. gross bookings rose 21% year over year in constant currency. Mobility bookings growth accelerated to 27%. Deliveries up 17%. Audience expansion and trip frequency hit records. Do these numbers herald a recession to you? How could people still spend so much on cabs and food delivery if the economy is about to fall apart? If things were really weak, Uber simply could not put up these numbers. To those big-time bearish money managers who only think about what the Fed's going to do, maybe you should be thinking about what the consumer's going to do. Go read the Uber call. Find out why this stock rallied 10% in one session. Get your hands dirty. Is there anything more economically sensitive than a gym membership? Is there a gym company that's been harder hit than Planet Fitness? Then how did it report a 5-cent earnings beat off a 66-cent basis? Planet Fitness has a franchise model. So the key metric is franchise revenue, which was up 9.1% year over year. If we were going into recession, let me ask you, would Planet Fitness have authorized a $280 million accelerated share buyback? I don't think so. Hence why that stock rallied 6%. A lot of people were worried about commercial real estate, right? I mean, I know there's so many subpar buildings in urban centers. So why the heck then did Barry Stern, like the super smart CEO of Starwood Properties, declare a 48-cent dividend, not just for this quarter, but for the one after it, right today? Strange behavior if you're worried about a commercial real estate recession, right? Well, maybe you shouldn't. Lots of people are concerned that the consumer's tapped out, right? Stop having a good time. We hear constantly how we need that consumer spending on discretionary items. Well, you know what? I'd say beer is one of those items. And this morning, the Down the Dumps Molson Coors symbol TAP puts up amazing numbers. Amazing. With stronger than usual shipments. They talked about continued growth through 2024. Hey, beer, I got ice in my cold beer. And that's what we used to say when we sold beer at the old Veterans Stadium in Philadelphia. People are buying beer again after a year-long hiatus. They got ice in their beer. You know what? And they're going out, too, even if they're doing it frugally. How else could Yum Brands, parent of Taco Bell, Pizza Hut, and KFC, put up such remarkable quarter this very morning? Their core operating profit grew by 10%. Yes, sales missed, but margins were terrific and earnings trounced the expectations, and that's what matters. Some might say it's natural for an animal health company like Zoetis to put up good numbers, as animal health is very important. But believe me, we know in a recession, people put off going to the vet with their pet. They don't go to the vet themselves. So Zoetis not only reported a great quarter, it also raised guidance. Clearly, people haven't started skimping on vet visits, so you get a 6% move higher. Look, I could go on and on, people. This is just a single 24-hour period. I know we have some weakness tonight in tech, but let's remember that almost every quarter we got today was a good one. The bottom line, there was just great quarter after great quarter after great quarter this morning. They just can't be seen by those who refuse to do the homework and only listen to central bankers, because it's too hard to do the stuff that I do. It does rankle me. But in the end, it doesn't matter, because we can see both the forest and the trees. Them, they wouldn't know the business end of a chainsaw. Let's go to Larry in Pennsylvania. Larry.
Hey, Jim. Booyah.
Booyah, Larry. What's up?
What's up? Hey. Got JP Morgan. I'm wondering if I should buy more of it or wait until it drops and buy more.
Well, don't we have? I think Leslie Picker's interviewing Jamie Dimon tomorrow, and I think the two of them are going to be terrific. It's going to be great, and I think the JP Morgan at 11 times earnings. I'm sorry, you are not going to get hurt that bad if you buy that stock at 11 times earnings. Let's go to Jeff in Sweet Home, Alabama. Jeff.
Hey, Jim. Big booyah and roll tide.
Roll Tide. Love it.
My question is about Nike. I'm in at 75.86 average. Bought all the way down, I guess, up until Friday. I should have bought more. My question is this: buy, sell, or hold?
All right, this is a very, very tough call, because I don't think Nike's doing well at all. But if they say, let's say they have a change in management, or they do something very radically different, you're going to look back and say, how did I not buy that at 72? I would hold on to it, but I don't want you to buy it anymore. We're going to go to Dave in New York. Dave.
Hey, how are you, Jim? Good to talk to you.
Dave, I couldn't be better, man. I was out there. It was real hot today. I liked it. What's going on with you?
Well, a few things. We'd also like to see the market doing a little bit better. But I was wondering with Pfizer,
what you're thinking on that stock? I
think
bought it a while
Pfizer.
ago.
No, I like Pfizer. I'll tell you why. They bought this company, CGen. It's going to do fine. They've got a great dividend, and I think that they're going to slowly but surely turn the ship around. Pfizer with 5.73% yield, give it to me. All right, yes, the Dow sank over 1,000 points yesterday, and yes, it rebounded solidly today, but not enough. The important thing in all this is that the company's reporting solid quarters of earnings, and that's what's going to keep the market afloat, even as we look at the big data and we start blaming, Jay Powell and all the rest of the gang. That's what you should be focused on, is the earnings. Mad Money tonight, Meta was one of the only big tech players able to soar this quarter. So what was the secret sauce that made that social media company transcend its peers? I know the answer. Then in yesterday's market meltdown, the VIX had its second largest single day move. After today's relief rally, can investors assume maybe we're out of the woods with the VIX? I'm going off the charts to find out. It's going to be surprising to you. And international flavors and fragrances. Yes, IFF has a new CEO at the helm, and I'm hearing his vision for the company behind some of your favorite snack foods and, yes, perfumes. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
I have to tell you, this is a bizarre earnings season where no one seems to care about earnings because the whole market's going crazy. That's too bad because there's a lot to learn here. Look at the digital advertising space. With the economy going south, the ad business tends to go with it. And in the past couple of weeks, we've gotten a bunch of red flags here. Lots of weaknesses. However, there is one big exception, and that's Meta Platforms, which is one of the few mega cap tech stocks to actually rally in response to its earnings report, even if that move didn't really last. So what's going wrong in this industry? And how the heck has Meta managed to transcend it?
House of pleasure.
Let's go through chronologically. The first sign of trouble came from Netflix when reported on July 18th. Despite delivering a healthy top and bottom line beat, we got some vague commentary about their nascent ad business. Basically, Netflix has a ton of demand from advertisers, but they don't yet have a large enough ad-supported subscriber base for that to truly move the needle. To me, that's a high-quality problem, and frankly, I think Netflix is actually worth buying right here, right now, because the stock's pulled back from last month's highs. A lot to like there. But when Alphabet reported a week later on July 23rd, YouTube had a nearly $300 million revenue miss, despite taking market share in the online advertising space for ages. It was easy enough to dismiss the YouTube miss at the time because it was offset by strength in Google search. Some analysts also pointed to YouTube-specific issues like increased ad inventory from Amazon Prime Video, which rolled out ads in January. Still, easy to dismiss that there was a problem, as I myself did, because I thought other areas were so strong people wouldn't care. I was wrong. YouTube weakness was all that mattered in the end for the stock of Alphabet. Now, when Pinterest, another one I like, reported last Tuesday, its stock tumbled 14% the next day. It was much harder to stay in denial after that. See, Pinterest issued lighter than expected guidance for the current quarter and said that they've seen some softness in advertising for certain sectors, like the consumer packaged goods companies. The stock has still not recovered from that disappointment. On the social media company front, Snap, the parent of Snapchat, lost almost 27% of its value on Friday.
The House of Pain.
After the company reported a bad quarter, absolutely horrendous guidance for the current quarter. Snap also called out a tough brand advertising market, citing weak demand from certain consumer discretionary verticals, including retail, technology, and entertainment. Not good at all. They know nothing! For what it's worth, Amazon had a small ad revenue miss when it reported last week, although advertising is still less than 10% of their overall revenue. Still, the fact that the business is struggling, well, that tells you a great deal, doesn't it? Wow, people really, really hated that quarter. However, amid all the carnage last week, we got a very strong report from Meta Platforms, the parent company of Facebook, Instagram, and the new Twitter imitator Threads, which actually, by the way, has a lot of people looking at it. Not to mention WhatsApp, which is just an amazing business on its own, and a bunch of metaverse initiatives. like the Ray-Bans that I like so much. They're really cool, by the way. Can't get them. They're sold out. No one cares. Even as the market started rolling over on Thursday, Meta still rallied nearly 5%. The stock's held up surprisingly well since then. That's because it did better than everyone else. See, Meta reported a very clean quarter. Great revenue growth, great earnings growth. Ad impressions delivered across their family of apps were up 10% year over year. Average price per ad also grew by 10%. Best of all, Meta didn't derail the narrative with light guidance. The outlook for the current quarter was very solid. Like Alphabet, Microsoft, and Amazon, Meta is one of the mega-cap tech companies that's spending tens of billions of dollars in AI infrastructure, meaning, of course, NVIDIA chips, servers, and associated networking equipment. But unlike the other mega-cap techs, they didn't get dinged for spending too much on AI this earnings season. Why? Well, because, as I've mentioned before, Meta offered some of the most clear-cut and straightforward explanations of how their AI tech will improve their business now. They gave you real enterprise use cases. And remember, at least for the time being, Meta's business is almost entirely advertising. Listen to CEO Mark Zuckerberg's explanation. I love this. It's real crisp. Quote, today, advertisers still need to develop creative themselves. In the coming years, AI will be able to generate creative for advertisers as well, and will also be able to personalize it as people see it. Over the long term, advertisers will basically just be able to tell us a business objective and a budget, and we're going to go do the rest for them. End quote. Can I tell you that no one is paying attention to that amazing, amazing bit of knowledge that he just imparted? That actually got some coverage, but mostly it was from me. There were some other important comments from Meta CFO Susan Lee that seemed to fly under the radar, even lower than that one. Lee was explaining how Meta managed to deliver such a strong advertising result, and she pointed to two factors. First, she said Meta is, quote, optimizing the level of ads within organic engagement. Huh? In plain English, that means they're finding more ways to increase the number of ads they can place on their various properties. But the second positive was more interesting. Lee said that Meta is, quote, enhancing marketing performance, end quote. And by that, she meant that they're helping advertisers who place ads on Facebook and Instagram understand how their ads are performing. Apparently, according to a study, U.S. advertisers are seeing a 22% higher return on ad spending after they adopt Meta Advantage Plus set of solutions. That is huge. Let me give you a long story short. Meta's winning in digital advertising because they don't just help companies place ads and target the right audience. They also help those companies measure the performance of their ads after the fact. People have actual knowledge of how their ads are doing. Of course, this has been Facebook's calling card for a long time. It used to be the case that they could track your online behavior from the time you saw an ad to the time you made a purchase. But after some new Apple privacy rules went into effect 3 years ago, Meta had to recreate that structure using different data. Now, though, they've clearly pulled that off thanks in parts to AI advancements. So here's what I think is going on. Yes, the digital advertising market is indeed softening. That makes total sense given where we are in the business cycle. Suddenly, advertisers are being more careful, much more careful in the way they place their ads. They need more data to justify how their campaigns are doing, and that's why most players are struggling. But Meta's still doing great. They can provide far better performance data than anyone else in the industry. That's called accountability. That makes them the safe choice for even the most struggling of advertisers. It does feel like winner take all, doesn't it? As for the other digital advertising plays, I think Alphabet deserves the benefit of the doubt, but I'd like to see a bounce back from YouTube starting this quarter. Pinterest and Snap can't keep up, though. While I hope Pinterest can figure out things with a relatively new CEO, whom I think is very strong, and the activists at Elliott Management keeping an eye on them, they are just very well run. But Snap lost cause. And tonight, Reddit reported on the surface it looked good, but it's trading down after the bell. I'm going to have to do some digging there to see what's going on. So the bottom line, it's precisely because the digital ad market's gotten worse that Meta's holding up great while the rest are struggling. If you're being careful with your ad budget, Meta's how you get the best bang for the buck. The others, they need to get more scale. In this business, it's get scale, get big, or go home. Mad Money's back after the break.
Coming up, don't fear the fear index. Some recent history might shine a light on this week's anxieties. Join Cramer off the charts. Next.
Today we're rebounding like crazy after yesterday's horrific beatdown. So what the heck do we make of this insanely volatile market? Look, if you want to understand where we are right now, it's worth putting the current move in some sort of context. That's why tonight we're going off the charts with the help of Mark Sebastian. Remember him? He's that brilliant technician who's the founder of OptionPit.com. He's our resident volatility expert. In order to get a better read on the situation, talk about it historically. He likes to keep an eye on the VIX, that's the CBOE Volatility Index, which is also known as the fear gauge, because it tells you when investors are terrified and when they're feeling more confident. And sometimes when the VIX does something crazy, it can help you spot major reversals in the market ahead of time. So let's talk about what happened yesterday when the averages crashed and burned. While this was a brutal decline for the market, it was also the second largest spike in the history of the volatility index. In other words, the fear gauge went to levels that we haven't seen since the event known as Volmageddon in February of 2018. That was right when the Eagles triumphed over the Pats in the Super Bowl, just so you want to get a little context. When money managers made a ton of bets against rising volatility and then got steamrolled when these same instruments blew up in their faces, causing the stock market to briefly collapse. That was a problem caused by financial engineering, though. It was a mechanical issue. Crazy. Now, if you want another analogy, the third largest VIX spike came in history. Came when China devalued its currency back in 2015. That was a fundamental issue. I was there with Carl and David. We couldn't believe the collapse that we had then. So check out this chart of the volatility index back in the summer of 2015, because Sebastian thinks it's important to compare the current moment with what happened back then. After all, yesterday we saw an even bigger spike in the VIX than we got when China devalued its currency. Sebastian points out that the spike back then was ultimately swifter than what we've been seeing. But he also sees some similarities. We had early panic in the morning. Oh, my, I remember I couldn't get any price discovery at all when I was on the desk. Huge VIX spike. Then it continued to stay high, ultimately closing in the high 30s. However, Sebastian noticed that within 2 months, the VIX was back under 20. As for the stock market, it bottomed the same day that the volatility index went insane. This was the bottom. Even if it was followed by some choppy action. The thing is, when you look at the intraday action, the stock market got hit harder on that day in 2015 than it did yesterday. Quizzical. At the intraday lows, the S&P 500 was down over 5% in response to the China currency devaluation. Then the next day, the averages opened higher before coming back down. By comparison, take a look at this pair of charts showing the recent action in the volatility index and with the S&P 500 from the past few months. Okay, so you've got the S&P. You can see these. All right, this is the S&P and up above, and the VIX down below. Clearly, yesterday's VIX spike was more severe than what we saw in 2015. But Sebastian wants you to focus on the fact that this move absolutely did not come out of nowhere. In fact, the VIX started moving higher back on July 15. It had been ratcheting higher and higher until yesterday. But crucially, when the S&P started selling off in late July, it's not like the world was ending. The Dow Jones Industrial Average and the Russell 2000 were having banner weeks. It's only in the last few sessions where everything plummeted. So now we're up to date here, and you can see this thing started going up. So the fear had been expanding. People just weren't talking about it. Still, Sebastian says it should have been a red flag that as money was rotating around the market, the volatility index kept going up. When you see the VIX moving higher along with most of the market, it often means that the rally is on its last legs, going up. It started pretty, it's really not it's really several indices, not just the S&P. The fear gauge is supposed to go up when stocks are going down. When that basic pattern breaks, something's wrong. Given the way the S&P was breaking down in late July, Sebastian thought the VIX probably should have been rising more rapidly. But it was just a slow, relentless climb. Even when things got real ugly last Thursday, the VIX didn't really take off. It wasn't until Friday that it started playing catch-up, with yesterday's event being the blowout event. This was Friday, and then yesterday's. Pretty interesting. Today we got a relief rally, but when you look at the overall performance of the major averages, Sebastian says they aren't really tanking, even as they pulled back from their highs. So take a look. Even the Russell 2000 is basically flat with where it was trading before it started soaring roughly a month ago. In fact, it's up so slightly month after month. Look at this. These are the real price. This is how much things have fallen. The Dow is down only slightly over this period. The S&P 500 is off more than 5%. Only the NASDAQ 100 is in true correction territory, down more than 11%. As tech stocks, they've gone out of style on the Wall Street Fashion Show, as you know. To Sebastian, this is all kind of nuts, because these declines simply don't justify the VIX spiking all the way to 65 at its highs yesterday. That's what shocked people. There's nothing going on in the American markets to justify that kind of move. Maybe if this were the Japan volatility index, a 65 reading, remember, Japan went down 12%, then rallied almost all the way back today. A 65 reading would make sense in Japan, but right now we're talking about the pin action off Japan. Long story short, Sebastian thinks the volatility index is wildly overreacted versus what happened to the averages during this period. He says this kind of situation is pretty rare. Typically, it doesn't involve a huge VIX spike like we had yesterday. In fact, the last time the VIX strength outperformed the S&P 500 weakness was back in early 2022, when the Fed was about to start raising interest rates. Take a look at the pair of charts showing how the S&P and the VIX traded back in 2022. At the beginning of the year, the S&P dropped 600 points. Over the course of 2.5 months, a pretty slow sell-off, VIX topping out at just over 36. From there, the market continued to pull lower, ultimately falling over 1,300 points peak to trough for a monster 27% decline. Although keep in mind, this was coming off 2021 when we were up huge. That's a much more bearish scenario than what happened with the VIX spike in 2015. In the end, though, Sebastian says this may be the moment that's more akin to Volmageddon in 2018. Maybe it's supposed to be a mechanical sell-off, this time in response to the implosion of the yen carry trade. People borrowing money in yen, then the yen going up, they get hurt, and then they have to unwind all their bets. Take a look at how things played out with the S&P and the VIX in 2018. Maybe that's the operative chart. Back then, we saw a slow rise in volatility as the S&P steadily rallied, followed by a massive spike in the VIX and similar massive stock meltdown, okay? You're up here. Of course, we ultimately bounced back from that nosedive, but it took nearly 6 months to get there. If things play out similarly, Sebastian says today's bounce will be faded tomorrow, okay? Faded, sold. And we could see another bout of selling before the averages truly bottom. In 2018, the S&P kept coming down, even as the volatility index made a lower high. If we see a day like this, this week, Sebastian says that you've got to start buying. It's the signal. However, if the S&P makes new lows and the VIX makes higher highs, he recommends staying on the sidelines. Bottom line, the charts interpreted by Mark Sebastian say that we're not out of the woods after this volatility spike, but if the next few days follow the Volmageddon 2018 playbook, and that's the nickname for that period, we could be looking at a genuine bottom sooner than you think, because the sell-off that we had may be somewhat mechanical and not important to the long-term view of the averages. Steve in Iowa. Steve.
Hey, Jim, I'm supposed to say booyah, right?
Yo, booyah right back at you. I had a nice booyah walking home last night. It really made me feel pretty good. It's been a long day. What's going on?
Hey, we've owned Walgreens since the early 70s. I've ridden it up. I've ripped it down. It went way up, and now it's way down. What's going to happen to Walgreens? You know,
we do have a really good CEO, Tim Wentworth, and I know he's got a plan. At the same time, when I saw what Amazon's doing to the small drugstores by doing all that same-day small package, it makes me feel like that you got to understand that the dividend's going to have to be cut again, and that the company, it may be a sell before it's a buy. I wish that weren't the case because I liked him very much, but I do think that Amazon's got them in the crosshairs. Let's go to Tom in Florida. Tom.
Hi, Jim. Big booyah. First-time caller.
Massive booyah back. What part of Florida are you from?
West Coast, Sarasota.
Oh, I love Sarasota. You know what? Clearwater and Sarasota, the sunniest places on earth. How can I help?
With demand for processing and high-band memory chips to power the AI infrastructure, what are your thoughts on Micron? They're building plants in the US.
I think Micron's way overdone on the downside. I would buy, if I had to buy 100 shares of Micron, I would buy 50 now and 50 at 80. I have great confidence in Sanjay Mehrotra to deliver good numbers. This stock is down from 157 all the way to 89. That, to me, says buy. Okay, listen to me. Sometimes when the VIX does something crazy, it can help you spot major reversals in the market. Right now, the charts, as interpreted by Mark Sebastian, say that we may not be out of the woods yet in volatility, but you know what? History says the bottom could come sooner than expected. I want you to think about that when all the gloomsters come on air telling you that everything's about to fall apart. See, because oftentimes they're wrong. Like only once in the last 40 years have they been right. Much more Mad Money ahead, including my exclusive with the International Flavors and Fragrances, fresh off our earnings, IFF. Did the company emerge this quarter smelling like a rose? I'm running through the numbers with the CEO. Then what does yesterday's landmark antitrust ruling mean for big tech as a whole? I'm going to give you what ultimately will be regarded as a sour take, but I don't care. And of course, all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer. As an old favorite, International Flavors and Fragrances has gotten its groove back. Regular viewers might remember that this designer of sense and taste for all sorts of industries used to be an incredibly consistent performer. But then the story fell apart. IFF did a couple of difficult acquisitions, I call them, then got hit hard by the pandemic, ultimately cycling through a couple of different CEOs. From its high in August of 2021 to its lows a year ago, the stock lost 60% of its value. Over the past year, though, it's come back with a vengeance. They've fixed the portfolio, they've cleaned up the balance sheet, and they've got good execution again, thanks in part to a new CEO. Now it looks like IFF's finally delivering consistent performance again, too. After the close tonight, the company reported a 17-cent earnings beat off a 99-cent basis with higher than expected sales. So how did they pull this off, despite a challenging environment for many of their end markets? Let's go straight to the source with Eric Fierwald. He's the CEO of International Flavors and Fragrances. A little more. Mr. Fierwald, welcome to Mad Money.
Thanks, Jim. Great to be here.
Well, I am thrilled to have IFF back and to have you on the show. This had been one of the most consistent companies. Maybe you can give a little bit of history, storied history about your company and what you're trying to steer it toward.
Sure. First of all, IFF stands for International Flavors and Fragrances, as you know, historically, and 135-year-old company. Grew up in flavors and fragrances, and then 6 years ago, as you know, started on an acquisition spree.
Yeah.
And over the last 6 years, there's been a lot of acquisitions and divestitures, a lot of corporate programs to try to get synergies, a lot of consultants and advisors, and just a lot of confusion and complexity.
It was very hard to understand what the company was doing.
Yeah, so since January, we've really tried to simplify things, get back to basics, and really focus on winning with customers. 5 business units, clear authority, end-to-end authority in each of the business units, and basic focus on customers, bring world-leading innovation, drive productivity, and take care of our people.
Okay, so Scent 37%, Taste 57%. Tell me, did you keep a lot of those clients? You had the best client list in the world.
And we still have a great client list.
Good.
So for the last 7 months, I've traveled all around the world, and I've met with more than a third of our customer revenue base. A lot of top-to-top meetings talking about what we've been doing with them and then what the opportunities are going forward. And I tell you, we're still on the core lists.
Right.
We're still with them. We still got great people. And we're just unleashing our people to work even closer with the customers to bring better innovation.
Okay, so let's say I know PepsiCo use you for hot taste. Hot is something that you guys do. A lot of people that may not understand that there are companies that their product would taste very differently if it weren't for IFF.
Oh yeah, so spicy.
That's you.
Potato chips or any kind of chips, but also we bring better health. We help companies reduce salt dramatically. So in chips, for example, you can reduce salt by 25, 30%, still have the same taste with our flavors, and have the great new taste that the consumers love, that grow the business.
Now, are you still getting those exotic scents from, say, flowers in Tahiti, like last night when we were watching the surfing? You still going and getting this stuff?
From all over the world, we get naturals for both our scent business and our flavors business, because that's another great trend. Consumers want naturals, and they want them to have great scents and great flavors.
So the big perfume company stuck by you?
Yes, and we have great perfumers. In fact, I'll tell you a quick story. So one of the top beauty companies in the world, the CEO, when I first got there, asked me to come over to France and have lunch with him. And we sat down with lunch. There was just 3 of us, our person that runs our fine fragrance business, the CEO and I. And he said, I'll give you one piece of advice. Keep your leading perfumers, your master perfumers. They're golden. They're what makes our company great. I said, we're going to do that.
Well, explain that to people, because it's kind of like brewmeisters. These are people all their lives. They have an amazing nose. They know more about the smell and taste. They also, I think, know what kind of taste that you were growing up with, so that they can reminisce those. I mean, they also know what smell Elizabeth Taylor had, because she was a great spokesperson for things that you did.
Yeah, there's nothing more important than our perfumers and our flavorists. So our perfumers get a brief, and our flavorists also get a brief from the fragrance company that says they want to perfume a new scent to have evoke a certain emotion, whether it's joy or energy or relax. And the perfumers know how to put together the molecules to achieve that. And it's really amazing. And now with AI tools, it's even more powerful what they can do. And I'll just give you an example. So our perfumers were asked by Charlotte Tilbury to help her develop a new line of fragrances. One that was bringing joy, one that was bringing energy, one that's bringing romance, one that's bringing relaxation. And we did it with something called the IFF Scent Cube, which has more than 5 billion data points. So we could help her develop these different scents that evoke these different emotions. And they've been extremely powerful. And she's out on TikTok talking about how she's worked with IFF to make that happen.
Well, that's fabulous because I think that you were absent from the mix for about a half dozen years. Yeah. And I was almost afraid to figure out, try to get my hands dirty in IFF because it wasn't clear where you're going to go biologics, where you're going to go pure nutrition, whether you were going to go or lost major big food companies. It sounds like you kept the large companies intact that you want and that you did have to cut the dividend.
Yes.
But that, I guess, was prudent given the acquisitions and the balance sheet. Huh?
Well, that was my first day as an IFF CEO.
How tough is that? Because IFF had a pristine reputation with that dividend.
Yeah, but we were borrowing money to pay the dividends.
That's never good.
And we were cutting R&D spend. We were cutting CapEx that we needed to invest in our growth businesses. You know, we've got 3 world-class businesses in flavors, in our scent business, and our health and biosciences, and we weren't investing enough in them. So we cut the dividend. We explained to investors that we're going to take that cash and invest it in growing our businesses. Bringing more innovation.
That's exactly the old IFF that I know I loved and championed since the mid-'80s. That's how long I've loved the company. But I did have to go dark for a while because I didn't understand what they were doing. I want to thank Eric Fierwald. He's the International Flavors and Fragrances IFF CEO. Guys, if these guys are back, I got to tell you, the runway here is very, very long with multiple years. Man, everybody's back after the break.
Coming up, pop open those umbrellas and tee up your toughest questions. Cramer takes on all comers in the lightning round. Next.
It is time. Cover the lightning round. Let me say this. I said about myself. This player, no, post office in my staff. Play this up. And then the lightning round is over. Are you ready? Skate down. Cover the lightning round. Crazy. Let's start with Sam. In Massachusetts, Sam.
Jim, MSCI is a great business of global investing. The CEO just bought $9 million of shares. What do you think of MSCI here at 526?
I want to own the stock of MSCI. They're having a good quarter and a good year, and I really like the fact that the company is the only single source of how we should value different indices around the world. Henry Freenet is doing a great job. Jason in Florida. Jason.
Big booyah to you, Jimmy Chill from Fort Myers.
Thank you, partner. What's happening?
Good. My fiance bought me a pair of these shoes 2 years ago, and since falling in love with her, I have fallen in love with this company. Is now the time to add, trim, or hold on to my on-holding?
No, I want to add, it's even better than when your fiance bought you those shoes because now they make it so that stones don't get caught in the bottom of it, which is really sensational. We were at a small dinner party this weekend, and there was nothing but stones on the table. I wanted to know what happened. I thought it looked like some sort of floral display. It was on and on. Let's go to Charlie in California. Charlie.
Hey, Jim. So my phone company recently got bought out by T-Mobile. U.S. Cellular. Is it a buy? USM.
Well, I happen to know that T-Mobile's a buy. Let's leave it at that. I think it's a terrific company, and if it comes in, I would buy more. Let's go to Brett in Massachusetts. Brett.
Namaste, Jimmy Chill.
Oh, man. Chill's in the house. What's happening?
Oh, I'm wondering about long-term. The Recluse Mongoose and I, my trading partner, are wondering about New Fortress Energy.
New Fortress Energy is, I hate to say it's a down stock, and we got to get Wes Edens on here, find out what the heck is going on, because I like the business, but something's going wrong there, and I can't figure out how to turn the stock around. Let's go to Joyce in Arkansas. Joyce.
Hi, Jim. This is Joyce. I have a question.
Absolutely.
I have a large holding in RPM in my portfolio. I want to know if I should buy, hold, or sell.
You want to hold on to that? I just read Frank Mitch the other day on RPM. That is one great company. It's an under-the-radar one, and I want you to own it. Let's go to Bill in Massachusetts. Bill.
Hi, Jim. I'm in my mid-60s, and I'm a club member, and I'd like to strengthen my position in DuPont because of the
Yes, I heavily suggest that you buy much more DuPont. I actually am using a $100 target for this club name because they're splitting the company into 3 companies, and I think they're all worth dramatically more together than this $78 company. I want you to buy. Double D. Let's go to Brian, Illinois. Brian.
Jim, thank you so much for everything you do for others.
Oh, thank you, man.
Thank you. Like next step, where does Palo Alto Network stand?
I think Palo Alto Network is terrific. I think Nikesh Arora is doing a great job. I would be a buyer of Palo Alto. And that, ladies and gentlemen, is the conclusion of the Lightning Round.
The Lightning Round is sponsored by Charles Schwab. Coming up. Is big tech a big target? Why a major court ruling is about more than just Google. Next.
Booyah, Jim. Your integrity makes you the booyah saint of Wall Street. Booyah, Jimmy Chill.
Booyah, Jimmy Chill.
Booyah, Jim.
Quadruple. That's a lot of booyahs. More than 60 years ago, Bobby Kennedy, a fascinating U.S. Attorney General, decided he'd have enough of the corruption at the Teamsters Union. He brought in the best prosecutors in the land, and he created a Get Hoffa squad, tasked to bring down the head of the union, Jimmy Hoffa. At the time, many believed it was purely a personal vendetta, although we later learned that he was neck deep in organized crime. This morning, I interviewed Jonathan Kanter. He's the brilliant assistant attorney general in charge of antitrust for our country after his victory over Google in federal court. The judge found that Google was a monopolist, one that conspired to suppress innovation by paying Apple about $20 billion a year to make Google the default browser. I totally get it. Of all the big tech outfits they're targeting, this one's the closest to an actual monopoly. Still, Google has the best search engine, and I'm glad it's the default for Apple, and I think it's fine that they pay Apple for the privilege. Why shouldn't they? Anybody really complain about this one? But Kanter argued that Google stifled others, and now we have to find out what the court will do to remedy the situation. It's possible to just say, stop paying Apple $20 billion and you'll still be the default, hence why Apple didn't participate in today's rally. But Kanter assured me that it's highly unlikely that Google comes out ahead here, which got me thinking. The companies that Justice and the FTC are targeting, Apple, Google, Amazon, NVIDIA, are among the best companies in America, maybe the world. If you ask pretty much anyone who is the lowest price provider all in of any sort of products, you're going to hear Amazon. Isn't that positive? If you ask who has the best phone, we know it's Apple. The regulators are actually charging them for the consequence of being the best. Google's just lost this case. Now, you got to worry about the next one against them, where Justice claims their advertising method harms advertisers. But the one I am most concerned about is the investigation of NVIDIA, a pioneer that spent more than $45 billion to develop a peerless chip franchise. $45 billion, which now has 90% market share when we're talking about semiconductors used for artificial intelligence. NVIDIA mortgaged the company to produce these chips. It was perhaps the greatest bet I have ever seen, at least in the tech sector. And for the Justice Department going after them, that's what happens for that? Look, I can live with the Google verdict, even as the Justice Department doesn't seem to care if we get the best search engine. At the end of the day, I don't mind government surveillance of big companies to ensure their practices are honest and fair. But going after NVIDIA for what could be the greatest innovation since the personal computer or the smartphone? I say we're on the precipice of a Get Hoffa moment, except this time, the Hoffa's innocent. It just feels like any highly innovative, highly successful business could run into the Get Big Tech squad, simply for being too successful, even as we want to encourage clean, honest success in this country. It's what made us great. Now, I asked Kanter directly about the Get Hoffa squad analogy. He laughed. But I really think going after NVIDIA for inventing the AI chip market is a bridge too far. They're pursuing the best companies on earth now, the companies that have restored America's economic preeminence worldwide. What's even the solution here? Does Justice want Jensen Huang to make worse chips? Should he get out of the queue at Taiwan Semi and allow other companies to get ahead of him, even though it's his turn? Break up acquisitions that the regulators already blessed? Play with one hand tied behind his back? It's not a stretch to wonder if there might be a wing of justice in the FTC that says, well, I don't know. You know what? That company is too powerful and making too much money. That's wrong. Let's go after it. You know what? That's pretty much exactly what Bobby Kennedy said about the Teamsters under Hoffa. Although, again, Hoffa was guilty of sin. And these companies, they're just guilty of simply being successful. This time it's about Andy Jassy, Sundar Pichai, Tim Cook, Jensen Huang, who somehow have become part of a road gallery that the regulators must put down to preserve the integrity of what? The right for a second fiddle to take over from first fiddle, even if the first fiddle is a much better player. I like to say there's always a bull market somewhere, and I promise to try to find it just for you right here on Mad Money. I'm Jim Cramer. See you tomorrow.
All opinions expressed by Jim Cramer on this podcast are solely Cramer's opinions and do not reflect the opinions of CNBC, NBC Universal, or their parent company or affiliates, and may have been previously disseminated by Cramer on television, radio, internet, or another medium. You should not treat any opinion expressed by Jim Cramer as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of his opinion. Cramer's opinions are based upon information he considers reliable, but neither CNBC nor its affiliates and or subsidiaries warrant its completeness or accuracy, and it should not be relied upon as such. To view the full Mad Money disclaimer, please visit cnbc.com/Mad Money disclaimer.